Hi everyone, and welcome to Acca P4 live session. We're going to pick it from where we stopped last time. Last time we finished chapter number 5, which was capital structure decisions or theories of gearing. So today we're going to pick it from capital asset pricing model from chapter number 6. So let's go straight to chapter number 6, which is capital asset pricing model. Every time I have to teach capital asset pricing model, I start by asking this question. If I've given you two investment A and investment B, and investment A, there is no risk attached to it, but investment B is a risky investment, and A is giving you a return of 10% and B is also giving you a return of 10%. Where will you invest your money? Okay, where will you invest your money? Will you invest it in A or will you invest it in B? The simple answer everybody will give to me is I will invest it in A, because A, I am not having any risk and I'm having what? 10%. But B, that I'm having risk, if I'm also having 10%, then why should I put my money in terms of B? Everybody will say we have to put it in terms of A. The question is, under what circumstance will you think of putting the money in B, which is risky? For instance, if I say, oh, the return on B is 18%, then some of you might think that, okay, let me go and put it in B, because even though I am going to take a risk, I am also going to get a higher return. And this is what we've said so far about cost of capital. We all said last week when we were doing the cost of capital, we said the elements of cost of capital are the risk-free rate plus a return to compensate for risk, which is the risk premium, a return to compensate for both business risk and financial risk. So that is the trade-off between risk and return. So capping is simply, capital asset pricing model is simply saying that when you want to invest on a risky investment, there is the need for you to get a higher return. So the return on a risky investment, should be equal to the return on a riskless or risk-free investment plus a risk premium to compensate for both business and financial risk. And that risk premium is calculated as the beta market return minus the risk-free. So we've all met this formula before from F9. This formula too is given to you in the exam room. So anytime I have to calculate my cost of capital using capping, the cost is to the company, return is to the provider of the capital. So the return I have to get on my risky investment is the risk-free rate plus the risk premium, which is measured as the beta into bracket market return minus risk-free. Examiner is supposed to give you the risk-free rate, and in theory we assume government securities are risk-free. So government short-dated securities like treasury bills rates are risk-free rate. Market return the examiner is supposed to give to you, which is basically the average return in the industry. Because portfolio theory is not in the syllabus anymore, the examiner is obliged to give you the market return. However, the difference between market return and the risk-free is sometimes called the equity risk premium, or sometimes the examiner will call it the market risk premium. So when the examiner says market risk premium or equity risk premium, it means he had already found the difference between the market return and the risk-free. Don't bother yourself to go and find the difference again, because he's done it for you. Then the next thing is the beta. What is the beta factor? Technically, beta is measuring risk. What is risk? In financial management, risk is of the fact that your actuals might not be the same as your expectation. And when we did value at risk, I told you that your actual being deviating from your expectation is measured as standard deviation. You don't need all this because portfolio theory is out. We need to, I'm developing you to get to the beta. So the risk of the project, the total risk, is measured as what is called the standard deviation. Okay, I can see that somebody is saying screen is back too. Okay, I see everything clearly here. So it means the problem is at your end. I see myself clearly here, so it should be at your end. So risk is divided into two. We have what is called unsystematic risk, and we have what is called systematic risk. Okay, because we've all learned the principle that do not put all your eggs in one basket, because when you put all your eggs in one basket and then the basket drops, you lose everything, isn't it? So when you don't put all your eggs in one basket, the finance terminology is you are diversifying, diversification. So when you diversify, you will be able to reduce risk. The risk you will be able to reduce as a result of diversification is what is called the unsystematic risk, which is also called the unique risk or the specific risk. It's a risk specific to the company. So irrespective of how much I will diversify, I should be able to what? Reduce that. So the more risk the more diversification I will undertake, the more I will be able to reduce the unsystematic risk, or probably I will be able to eliminate it. But there is one risk which is called systematic risk. Is specific to the project, is what? Not specific to the company as a whole. It's systematic to the project. Wherever the project will be, it should be there. And that systematic risk cannot be reduced or eliminated as a result of what? Diversification. So the difference here is that unsystematic risk can be reduced, but systematic risk cannot be reduced as a result of diversification. And systematic risk is also called the market risk. So this is where I can pick you from in your lecture note. So when you come here, you will see that we are actually dividing the risk into unsystematic, which is also called unique or specific risk to the company, and you can what? Reduce it or eliminate it as a result of diversification. Systematic risk, also known as market risk, you cannot what? It can never be avoided, and then it's part and parcel of the investment. Therefore, you cannot what? Reduce or eliminate it. And this is the diagram for it. Nobody is going to ask you to draw the diagram anyway. But the common sense is, if I've got only one investment, I have to face systematic and the unsystematic risk, which is going to be my total risk. However, when I start to diversify, when I start to bring in more shares, it means I'm diversifying. As I am diversifying, do you see the unsystematic risk reducing? You see the unsystematic reducing. As you are diversifying, the systematic risk is still what? Constant. So as the unsystematic risk reduces through diversification, as more you diversify, as more the unsystematic risk is reduced. And therefore, from this point onwards, you see that I am left with only the systematic risk. It means at that point, all the unsystematic risk is eliminated, and therefore we say the investor has fully diversified, and we say you have a well-balanced portfolio. You have a well-balanced portfolio. And the meaning here is that you are fully diversified. So subsequently, when you keep on diversifying, it's not necessary, because you can't reduce any risk, because the only risk that is left is what is called the systematic risk. If you come here, that is the formulas I've given to you. Okay, the capping formula is waiting for you in the exam room. There is only one thing I would have to bring your mind on. If you look at the formula I quoted here, I said the return on a risky investment is the risk-free rate plus the beta market return minus the risk-free rate. Okay, I know at F9 level, your syllabus restricted you to use the CAPM to calculate cost of equity. So most students think that we use CAPM to calculate only cost of equity. That is not the case. No. Okay, we use CAPM to calculate the return on any risky investment. For which equity is risky, debt is risky. So when I want to calculate my cost of equity, I will say risk-free plus the beta equity, which is equity beta, multiplied by market return minus risk-free. If I want cost of debt, I will say risk-free plus the debt beta, measuring the risk associated with the debt, into bracket market return minus risk-free. When I need a WACC, the WACC can be calculated as risk-free plus the weighted average beta, multiplied by market return minus risk-free. So the key thing you need to remember here is the formula is the same. However, the result is dependent on the beta you are putting in. When you put it equity beta, it gives you cost of equity. If you put in debt beta, it gives you cost of debt. If you put in the weighted average beta, it should give you the WACC. Straightforward. So this is the basic thing. Having said that, so far as even P4 is concerned, in most cases we use the cost of equity or the CAPM to calculate the cost of equity. So let's go straight to our note. This is what I can bring your mind on. We've explained these letters, so it should be fine. Okay, now where I am so much concerned about, the B is the beta. The B is the beta factor. Okay, the B is the beta factor. Okay, so that B is the beta, and that beta can either be equity beta or debt beta or the weighted average beta. Okay, which beta? That beta is in relation to, as I've been saying here, that beta depends on, is it equity beta, debt beta, or the weighted average beta. So that one would depend on what beta is given and what you are putting in and what you need. So if I need my cost of equity, I would have to put in equity beta. If I need my cost of debt, I have to put in debt beta. If I need my WACC, I need to put in my weighted average beta. Brilliant. Okay, so now let's go to what I technically need. Specific or systematic business risk and systematic financial risk. Okay, now this is the development. We've all said that beta is going to measure the systematic risk. So systematic risk is measured by the beta factor, because CAPM is making an assumption that the investor is rational. And because the investor is rational, the investor will want to have a well-balanced portfolio. And once you have a well-balanced portfolio, all the unsystematic risk will be eliminated. So the investor will be operating at this level. And if the investor is operating at that level, the investor faces only what? Systematic risk. And that systematic risk is what is measured by the beta factor. As I started illustrating, I said here that the total risk is measured by the standard deviation, but in the formula, it's not standard deviation that we put in there. We put in only what? The beta. And that beta is not measuring the total risk. That beta is measuring only what? The systematic risk. And as we did last week, we said a company will face business risk and financial risk. So when I say beta measuring business risk, it is called systematic business risk. If beta measuring financial risk, we will say systematic financial risk, isn't it? So that is that division. But is the examiner going to be using those terminologies? No, in the question. It is your responsibility to come out with them. And I'm going to lead you just as we did last week. So be with me here. Okay, just as we did. So be with me here. If a company is having a capital structure which is made up of only equity, A company can also have a capital structure which is made up of equity and then debt. Okay. We said last week, if a company is having only equity, then that company is called an ungeared company. If the company is having debt, then we say it is geared. Okay, a company that is ungeared faces only business risk. A company that is geared will face business risk and then financial risk. Okay, now let's come to beta. So when I'm talking to you in a question and I tell you that the equity beta of this company, which is ungeared, what is that beta measuring? That beta is supposed to measure risk, systematic risk. And because this company is all equity and an all equity company will face only business risk, then its beta will measure only systematic business risk. I don't normally even want to bring the systematic because once it is beta, the systematic is implied. So the equity beta of all equity company will measure only business risk. The same way, when I come here and I say the equity beta of this company, what have I told you? This company, which is a geared company, is facing business and financial risk. So if it's facing business and financial risk, then its equity beta will measure what risk? It will measure both business and then what? Financial risk. So be with me. The problem in P4 exams is examiner is not going to tell you geared beta or ungeared beta. Examiner will just say equity beta. So when the examiner says equity beta, it is your job to decide through the question as to whether the equity beta is ungeared or equity beta is geared. So when they say equity beta, the equity beta could be either geared or ungeared. And when it is geared, it means the company is having debt and equity. And as such, that beta will measure business risk and then what? Financial risk. But when the equity beta is for a company which is ungeared, it means that company is having only equity. And that equity beta will measure only what? Business risk. If you miss it, your calculations you're going to do accordingly, you are also going to miss that. So when they say equity beta, you need to pause and ask the question, are you geared or are you ungeared? And that would depend on which company are you bringing that beta from. If I'm bringing it from a company which is ungeared, then obviously that beta is ungeared and it's measuring only business risk. Same way, if I'm picking it from a company which is geared, then the beta is geared, which will measure both business and then financial risk. Because we have to introduce another term. That other term is what is called asset beta. This is what the examiner will use to confuse you. He might either use equity beta or asset beta. Are they the same? They are not. Asset beta measures only business risk. So asset beta is like an ungeared beta. Or ungeared, let me put it this way, equity beta. So watch the terminologies, because when you come here, we've said if I say equity beta and that equity beta is measuring only what? Business risk, we call it an ungeared beta. We call it an ungeared beta. So watch out for that. An ungeared beta, which is measuring only business risk, is what in some terminologies they will say it is called what? An asset beta. So asset beta measures only business what? Risk. Now let me bring you to this level. If there is a company which is having equity and debt, and I tell you its asset beta is equals to, let's say, 1.2, what have I told you? Even though this company is having debt and equity and it is geared, because the question has stated asset beta, the examiner is telling you, even though this company which is geared is having business risk and financial risk, I have given you its beta that measures its only what? Business risk, because I have mentioned asset beta. And once I have got only the beta that measures its only business risk, its whole beta is not only for business risk. It beta, because this company is geared, its overall beta should measure this business risk and then financial risk. So if he has given me only 1.2, which is measuring only the business risk, for me to be able to calculate the cost of capital of this company, I also have to bring the financial risk. So I have to change from the ungeared beta to the geared beta. And anytime you are thinking of moving between geared and ungeared, last week we saw you have to think about Miller and Modigliani. So Miller and Modigliani had given us a formula. Anytime giving me a geared beta, I want ungeared, or giving me ungeared, I want the geared. Miller and Modigliani is calling you, this time with respect to beta, and they are saying that your asset beta, which is ungeared, is equals to your equity beta geared, equity over equity plus debt, 1 minus t, plus the debt beta, into bracket debt 1 minus t divided by equity plus debt 1 minus t. This formula is waiting for you in the exam room. The most important is when and how to use it, and I will need it when I am moving in between geared and an ungeared beta. That is when I will need this. However, Miller and Modigliani assume that debt is risk-free. So if debt is risk-free, then any debt or any item which is risk-free, beta measures risk. So if it is risk-free, then the simple argument is that that debt which is risk-free will have a beta which is equals to what? 0, because beta measures the risk. So if there is no risk, then the beta should be equals to 0. If that beta is equals to 0, then if that debt beta here is equals to 0, everything here will be equals to 0, and we will say the asset beta will be equals to the equity beta geared, equity over equity plus debt 1 minus t. So when you go to the exam room and the examiner don't give you a debt beta, your assumption you are going to make in the room is that debt beta is equals to 0, and as such all this bit of the formula you just discard it and concentrate on only the first bit. But when you go to the room and the examiner gives you a debt beta to be, let's say, 0.5, then you cannot ignore this bit. You need to think of what? Expanding that formula, because they've given you a debt beta. But having said that, all the P4 questions that I see, you are going to assume that debt is risk-free. But examination is examination. So when you go there and he gives you a debt beta, you haven't got a choice. There is the need for you to expand it. So let's go to our note and we apply this one straightforward. Let's go to the note and we apply on this. So this is what I've explained. What is an asset beta? What is what? Equity beta. We all know that. Okay, and this is the formula. The formula is waiting for you. So let's use this example to illustrate. Okay, Gauss PLC is an all equity company whose beta coefficient is 0.95. Styles PLC is a levied company and in all other respects has the same risk and operating characteristics as Gauss. The capital structure of Styles PLC is as follows: nominal value, market value, equity, debt. The debentures of Styles PLC are virtually risk-free and the corporation tax rate is 40%. What will be the predicted beta of the equity of Styles PLC? Okay, if I need the equity beta of Styles, I need to ask myself, Styles, are you geared or are you ungeared? If you look at the capital structure given, as I told you, some of the questions the examiner is not going to be mentioning those words. If you look at the capital structure of Styles, they have got equity and debt. So it means Styles is a geared company. Even though this question told us that Styles PLC is a levered company. Levered company, that is the alternative name of a geared company. So even though this question told me, but if the question didn't tell me that, I should be able to know that this company is what? Geared, because it's having debt. Okay, Gals PLC is an all equity company whose beta coefficient is 0.5. So Gals is what? All equity. Therefore, that is ungeared. Gals is what? Ungeared. Okay, all these two companies are similar. Therefore, they should have the same business risk. Miller and Modigliani assumes that companies in the same industry will face the same business risk. So these two companies will face the same business risk. So giving me an ungeared beta. Now I need the beta of Styles, and Styles is a geared one. So giving me an ungeared beta, will I be able to change it from the ungeared to the geared? And as we said, anytime you want to move between geared and ungeared or ungeared and geared, Miller and Modigliani is calling you. Which Miller and Modigliani? This is with respect to beta. Therefore, I need the asset beta formula. And that asset beta formula, we quoted it as this. Here we are assuming debt is risk-free. So everything here, we are just cancelling it. Therefore, my asset beta, which is the equity beta ungeared, we are picking it from Styles, and Styles is having equity beta ungeared of 0.95. You are just filling the formula. It's equals to the equity beta geared. For Styles, I don't know. Multiply by what is the market value of equity of Style. If you go to the question, market value of equity of Style is 15, debt is 6. So I will say 15 plus what? 6. Tax rate is given to me as 40%. So 1 minus 40% will give me 60%. And what will be the equity beta geared? And the geared one is for Styles. So you borrow ungeared to get the geared, or you borrow the geared in order to get the ungeared. This is all about what Miller and Modigliani is about. So I pick my calculator. I will say 0.6 times 6 plus 15 times 0.95 divided by 15, and that will give me 1.178. And because this is for Style, and Style is what? A geared company. This beta is measuring the business risk and is measuring what? The financial risk. So technically, the business risk is the 0.95, and the difference between that of the 0.228 is for the financial risk. Obviously, nobody is going to ask you to be doing these calculations anyway. Okay, so that is basically that. So if I wanted to calculate the cost of equity of Styles, they've given me the beta of Gals. I use the Gals beta, come and get the beta of Styles, put it in the capping formula, and that will give me the cost of equity of what? Styles. So that is the basis that you're going to think of. Anytime I need to move between geared and ungeared, Miller and Modigliani is calling me. What do I need? If I need cost of equity, preposition 2, as we did last week. If I need market value, preposition 1. If I need what? WACC, preposition 3. If it is something that to do with beta, then I have to go to what? The asset beta formula. So this is how you would have to be interacting with the question. So now let's go to our note and we go and apply it properly. Okay. When we did investment appraisals and we were calculating MPV, we all said to calculate MPV, I need number of years, I need the relevant cash flows, and I need an appropriate discount factor. An appropriate discount factor. And we said the word appropriate there is telling you the discount factor should be consistent with the cash flows. Okay, so we are moving to what is called project-specific cost of capital. My worry for my P4 student always is this. Is the examiner going to tell you calculate project-specific cost of capital? P4, the examiner might not even say anything about it. You read the question and it should come up with you. Okay, so examiner creates investment appraisal question, sales variable cost, specific fixed cost, tax savings on capital allowance, and then initial investment, residual value, working capital. You come and get your net cash flow. I need the appropriate discount factor. Under what situation will I see that I need a project specific cost of capital? When we did cost of capital, we said we cannot use our current WACC when business rates change significantly, when financial rates change significantly, or when both change significantly. So the examiner is going to create the scenario, and it's your job to see from the scenario what discount factor you should use. So I normally create a scenario whilst I'm teaching. So when the examiner is creating the scenario, he's going to say, okay, this is company A. Company A is, for instance, in the education industry. And their beta, equity beta is 1.5 for the sake of argument. And their current WACC is, let's say, 15%. And that is what they use to appraise all investment. And A, being in education industry, is now evaluating a project in, let's say, the mining industry. I'm just creating scenarios. So you are in one industry, the new project is going to be done in another industry. That should tell you something. As long as I'm diversifying from wherever I used to be into a new place, Miller and Modigliani principle with respect to business rates is that companies in the same industry faces the same business rates. So when they were calculating this WACC of 15%, they will use the business risk in the education industry and the financial risk associated with the company now to calculate this 15%. If I am going to the mining industry, what will be my cost of capital? My cost of capital will not be the 15% because that 15% is not reflecting the risk, which is the business risk and the financial risk in the mining industry. So this should call for the calculation of a specific cost of capital that will be attributable to our mining project. And that is what is called the project specific cost of capital. Okay, so the examiner might even create the question silent. A, just calculate the NPV. And whilst you're going to calculate your NPV, you need that particular cost of capital specific. And as such, the moment you see you are diversifying or you are moving from your current industry to another industry, project specific cost of capital is flashing you. So what will I do? My cost of capital, my WACC for calculating the NPV for the mining is what we call it project specific WACC. And that project specific WACC, how will I calculate it? WACC should always reflect a business risk and then what? Financial risk. That is what we know. So what will be the business risk in the mining industry? Miller and Modigliani assume that all companies in the same industry will face the same business risk. So I will go to the mining industry and go and look for a beta. The beta I will look for is what I'm going to use as a proxy, trying to get the business risk out of that beta. So when I go to the mining industry and they've given me equity beta of 1.7, for the sake of argument, I'm creating the scenario the way in the question before I even bring you to the principle, because my worry for you is how you see that this is what the examiner wants me to do. So if I go to the mining industry and I see a beta of 1.7, I need to ask myself, this is equity beta. Equity beta I'm picking, are you geared or are you ungeared? Companies in the same industry face the same business risk, but they don't face the same financial risk. Financial risk is your debt equity proportion, and companies in the same industry don't have the same debt equity proportion. So I need to ask you, this 1.7, are you geared or are you ungeared? That would depend on the company I'm picking from. So if the question had told me the company I'm picking, this 1.4, is having debt and is having what? Equity, then straightforward, this beta is geared, but I need the ungeared that will measure only what? The business risk, which we have the same business risk. So what will I do? When I pick this proxy beta, and because that proxy beta is geared, I would have to what? Ungear it. So your first stage, pick that proxy beta. When that proxy beta is geared, your second stage will be to ungear it. And when you ungear it, you have got only the asset beta. How will you ungear it? Giving me geared. If I want to ungear it, Miller and Modigliani is calling me. Which Miller and Modigliani? This is beta. So I will use the BA is equals to the equity beta geared, equity over equity plus what? Debt 1 minus T. So I will use the debt equity of this company. I put it 1.7 here, put it debt equity to come and get the asset beta. That asset beta I will get is measuring this business risk of the mining industry. And when I pick that one, I don't face only what? Business risk, because WACC should reflect business and financial risk. So you go to the mining industry to go and look for the business risk, and that is what we have brought. Then you ask yourself, is my company having debt? If my company is having debt, then I will also have what? A financial risk. So I have to bring this financial risk, and as such, I have to re-gear to reflect my debt equity. So your third stage will be to re-gear. And when I re-gear, I will come and get my equity beta geared in relation to my debt equity. And when I finish, I will put it in the capping to calculate the cost of equity. And then finally, I will calculate WACC. And this is the project specific WACC I have to use to discount the cash flows associated with the mining project. So some of the questions you see the examiner tempting you, telling you that, oh, we are in the education industry, our current WACC is 15%, and that is what we use to discount or appraise all projects. Then student will just straightforward go and pick the 15% and they are discounting. You are somewhere altogether. Unless the project we are doing is also in the same education industry, and as such business risk is not changing, and financing the project debt equity proportion will not also change. So business risk hasn't changed, financial risk hasn't changed. In that case, I can use my 15%. But the moment any of them, financial risk or business risk, will change, automatically I have to go and calculate the project specific cost of capital. Watch out. So let's go to our notes and I will pick this one to explain. So they gave you the stages. That is what I've explained. Pick the first, identify a proxy beta from the industry in which the project is supposed to be undertaken. Ideally, get the industry average. But when they just give you one company in that industry, pick it like that. If you pick the proxy beta and that proxy beta is geared, you have to what? Ungear that proxy beta to determine what? The asset beta that measures only the business risk using the above formula that we stated. Then you ask yourself, is your company having debt? If my company is having debt, I will also face financial risk. So re-gear it to reflect your debt equity. And then that will give you the cost of equity geared. Put it in capping and put it in WACC. So I create a joke out of this. And the joke is that calculating project specific cost of capital, it follows normally 5 stages: proxy, ungear, re-gear, capping, and WACC it. Proxy, ungear, re-gear, capping, and WACC it. So that is the case. So we're going to use this question to illustrate. So let me pick this question straightforward. Hot Alert PLC. Hot Alert PLC produces domestic electric heaters. The company is considering diversifying. These are the things or the words you have to be noting them. The company is considering diversifying into the production of freezers. So when we are diversifying from electric heaters to production of freezers, business risk is changing. So project specific cost of capital, that is the time it is flashing me in the exam room. Data on 4 listed companies in the freezer industry and for Hot Alert are shown below. Freeze Up, Glow Cold, Shiver All, Top Piece, Hot Alert. Fixed asset, working capital financed by bank loans, ordinary shares, reserves, turnover, earnings per share in pence, dividend per share in pence, price earnings ratio, beta equity. The power value per ordinary share is 25p for Freeze Up and Shiver All, 50p for Top Piece and £1 for Glow Cold and Hot Alert. Corporate debt may be assumed to be almost risk-free and is available to Hot Alert at 0.5 above the treasury bill rate, which is currently 9% per year. Corporate taxes are payable at a rate of 35%. The market return is estimated at 16% per year. Hot Alert does not expect its financial gearing to change significantly if the company diversifies into production of freezers. Required, estimate what discount rate Hot Alert should use in the appraisal of its proposed diversification into the freezer production. Corporate debt is often assumed to be risk-free. Explain whether this is a realistic assumption and calculate how important this assumption is likely to be to Hot Alert estimate of the discount rate in Part B. It should be Part A above. For this purpose, assume that Hot Alert and other 4 freezer companies all have a debt beta of 0.3. Discuss whether systematic risk is the only risk that Hot Alert shareholders should be concerned about. The C is straightforward. We said total risk is as a result of systematic and unsystematic risk. Should we be concerned about only systematic risk? We can only think about concerning about that systematic risk if all the unsystematic risk is eliminated. At what point should all the unsystematic risk be eliminated? That will be achieved when we have a well-balanced portfolio and we are fully diversified. In reality, how many different investments should I combine in order to have a fully diversified portfolio? I don't know the answer. If I know the answer, I won't be standing here because everybody will be looking for me. Okay, so that is the argument. Capping made that assumption that the investor is rational, so the investor will have a well-balanced portfolio. In reality, should I have 10 different investments, 5 different investments, 20 different investments, 1 million different investments for me to claim that I am fully diversified? It's something that cannot be determined in reality. So that was an assumption, and it's one of the criticisms of capping. So you cannot think of being concerned only about systematic risk. Even though you have diversified, you also have to be a bit concerned about the unsystematic risk, because you can't say you are fully diversified where the unsystematic risk will be eliminated. Okay, so that is the C. I'm doing it like I'm sitting in the exam room. The C is straightforward. I will write that one, claim the marks, and come to the A and B where the number crunching are. And that might likely to take more time than the C. I pick the C, I've got the marks, I bounce on that, and I'll be doing the A. Okay, so let's go to the A. Estimate the discount rate Hot Alert you use in appraisal of the proposed diversification into the freezer industry. As long as I am diversifying, what should come to mind? Business risk is flashing me. I am changing. So once I'm changing, you need to calculate a project-specific WACC or project-specific cost of capital for this freezer world production. How will I calculate project-specific WACC? Proxy and gear, re-gear, capping, and WACC it. So I come to the question. I need to get a proxy, and that proxy beta should come from the industry in which the project is supposed to be undertaken. Which industry is given to me? We are going to the production of freezer industry. Question said, data on 4 listed companies in the freezer industry and hot alert are shown below. Hot alert, currently, we are in the electric heater industry, and these 4 are in the freezer industry. Ideally, I have to pick the industry average beta. So these companies in the freezer industry, what are your betas? I come here. What is the question saying? Beta equity, which is the same as equity beta. So I go straight to my calculations. I will say 1. I need a proxy beta. Okay, my proxy beta will come from those companies involved. Can I say F, G, S, and then T? What are the betas? The betas given are the equity beta. For first one is 1.1, 1.25, 1.30, and 1.05. When I pick the beta, the question I need to ask is, I need the industry average. So what will be the average? My average will be 1.1, all these divided by 1, 2, 3, 4. 4. So this plus that plus that plus that. So I pick my calculator quickly, and I'm going to say 1.1 plus 1.25 plus 1.3 plus 1.05 divided by what? 4. And that is giving 1.175. This is my average word, beta. And these betas are picked. Are you geared or are you ungeared? Question didn't say it. All what the question said is equity beta. And I told you, when we say equity beta, it could be geared or ungeared. So I need to go and ask, these companies that I'm picking from, are you having debt? If they are having debt, then they are geared. If they are not having debt, then they are ungeared. This is where the challenge is. That's why I took the time to do those boxes and the branches for you. So when I come, all these companies are having what? Bank loans. And bank loan is a debt. So if they are having debt, then their betas here are geared, and therefore this is the average word, geared beta. If I have got this geared beta as proxy, what should I do? I am supposed to ungear it. If I'm supposed to ungear, Miller and Modigliani said the asset beta is equal to the equity beta geared, equity divided by equity plus debt, 1 minus T. On the assumption debt is risk-free. So what am I going to do? I need to get the value of equity of that industry. I have to get the value of debt of that industry because I'm picking the industry beta. Compare like against like. Therefore, I will need my industry debt. What will be the industry debt? The industry debt will be the sum of all the debt of the companies in that industry. And these companies' debt are 5, 3, 12, 6, 18, and then what? 4,000. So I pick them quickly. I will say this is 5,300 plus 12,600 plus 18,200 plus 4,000. And how much will I get? 5,300 plus 1,600 plus 18,200 plus 4,000, and that is giving me 4,100. I will also need the equity of the industry, and equity market value is ordinary share number multiplied by market price. So how will I get the equity? I also have to go and calculate the value of the equity for F, G, L, and then what? T. What will be their equity? Equity should be the number of shares multiplied by the market price. So what is the number of what? Shares for each of the companies. Let's go to the question. Question said the ordinary share capital are these for each of the companies. But look at the asterisk. They said the nominal value or the par value per ordinary share is 25p for freeze up and shiver all. So to get the number of shares, I have to get the share capital and divide by what? The 25p, isn't it? So my number of shares, I'm going to pick the share capital and divide by these what? Nominal values. So first one, I will say with freeze up is going to be 4,000. I pick my calculator. 4,000 divided by 0.25. and this is 16,000. I do the same thing for Glow Cold. Glow Cold, the nominal value is 1. If you read further, I said £1 for Glow Cold and Hot Alert. So if Glow Cold total share capital is 9,000, 9,000 divided by 1 is 9,000. Shiva All up there, they said is 25p. So 3,500 divided by 0.25 is giving me 14,000. And the last one is top piece. They said 50p for top piece. So top piece is 5,300 divided by 0.5, and that is giving 10,600. I've got the number of shares. I need market price. I go to the question, what is the market price of the company share? The question didn't give me the market price of the company share, isn't it? So what is the argument here? The argument here is that I need to find it, but they've given me PE ratio, and we all know from F9 that giving me PE ratio, market price is equals to PE ratio multiplied by earnings per share. So giving me earnings per share, giving me PE ratio, I should be able to get the market price. So I'm calculating it as the PE ratio multiplied by earnings per share. Are they given in the question? For each of these 4 companies, they've given us their earnings per share in pence. They've given us their PE ratio. So when I pick the earnings per share and I multiply by the PE ratio, it should give me the market price. So that is what I'm going to do. In the exam room, I'm not going to calculate them one. You haven't got the time. Move on. That is not the main question. Move on. So we're going to say, if I pick freeze up, its PE ratio is 12, multiplied by its earnings per share is 25p. So multiply by 0.25, and that will give me 3. I move on. The other one's PE ratio is 10 times earnings per share is 0.533, and that is giving 5.33. And the next one is 9 times 0.318. Okay. And that is 3.429. And then the next one is 0.323 times is it 14, and this is 4.522. Multiply to come and get the market value of equity. Okay, so that times 10,600, and that is giving 47,933. 14,000 times 3.429, and that is 48,006. 9,000 times 5.33, that is 47970. 16,000 times 3, and that is 48,000. Okay, so this is the industry total equity. Sum up all of that. 48 plus 47,970 plus 48,006 plus 47,933, and that is, I don't think my figure is right. 48,000 plus 47,970 plus 48,126, and then plus 47,933, and that is giving 191,909. So this is my equity. Don't forget about your focal point. Don't forget, what am I looking for? This is the formula I want to fill, and I needed the equity. That's why I had to go and calculate. I needed the debt. Now I have got them. I can bring myself up. I've got the beta of geared of 1.175. So when I come here, I will say my asset beta should be given as the 1.175 multiplied by the equity is 191,909. 191,909. If you are in hurry, you can do them in thousands and do 192 and you go away. Plus the debt is 4,100, and tax rate according to the question is 35%. 1 minus 35% will give me 0. What is this? 65. And what will be that asset beta? Calculate the asset beta, and that asset beta is giving us a figure of, is it 1.035, and this will measure the business risk in that new industry. Then I come and ask myself, if I go to that industry, I will face this business risk, but my company as a hot alert, am I having debt? If I'm having debt as a hot alert, I am not going to face only business risk. I will face financial risk. So I come to the question, hot alert, are you having debt? He's saying hot alert is having bank loan of 17,400. So if hot alert is having debt, then I would have to re-gear to reflect hot alert debt equity proportion to bring the financial risk. So that will call for the re-gearing. So 3, I will say I would have to re-gear to reflect the debt equity of my company, which in this case is hot alert. Okay, so what will I do? I will need the same formula, which is asset beta is equals to this, equity over equity plus debt, 1 minus the T. Therefore, now I have got this asset beta, which is 1.035 is equals to, I'm looking for the geared. What debt equity do I need? I need the equity and debt of hot alert. Look at it well, hot alert. Therefore, hot alert, what is your debt? Hot alert debt is given to me. When you go to the question, the bank loan of hot alert is given as, is this 17,400? I will also need the equity of hot alert. And the equity is number of shares multiplied by the market price, isn't it? Number of shares multiplied by market price. Hot alert ordinary shares is 4,000 and its nominal value per share. When you come here, they said it's £1 for glow cold and hot alert. So its number of shares should be 4,000 divided by 1. Okay, so I will say hot alert, your equity is number of shares is 4,000 divided by 1 multiplied by your market price. Market price wasn't given. They gave PE ratio and earnings per share. So when I come here, hot alert, your PE ratio is 8. Your earnings per share is 106 pence. So which is 1.06. Can I multiply each trade as 8 multiplied by 1.06? And this one will give me the equity. So 8 times 1.06 times 4,000 is giving me 33,920. I've got hot alert equity and debt. So here is 33,920, 33,920 plus its debt of 17,400, net of tax is 65. And then what will be the equity beta geared? I take 17,400 times 0.65 equals plus 33,920 equals times 1.035 divided by 33,920, and the answer is 1.38. So this is the beta measuring the business risk of the freezer business we want to do and the hot alert financial risk. So this measures our whole business and financial risk. Put it in the CAPM to get your cost of equity. So 4, I will say my cost of equity will be the risk-free plus the beta equity, market return minus what? Risk-free. What is the risk-free? Red. I go to the question. Question said it here that the corporate debt may be assumed to be risk-free at this paragraph and is available to hot alert at 0.5% above the treasury bill rate, which is currently 9% per year. And we said risk-free rate are assumed to be the government treasury bill or government security rate, and the treasury bill rate is now 9% per year. So my risk-free rate is going to be seen as 9% plus the beta we calculated is 1.38, market return minus the risk-free. So I go to the question, where is the market return? Question says the market return is estimated to be 16%. So I will say 16% minus the 9%. And what will be the cost of equity? So 1.38 times bracket 16 minus 9, close the bracket, plus 9 is giving me 18.66% as my cost of equity. What do I need next? I need to calculate my project specific WACC. And WACC is the cost of equity, equity over equity plus debt, plus cost of debt, 1 minus T, debt divided by equity plus debt. It's a formula business. Now let's do the substitution. My cost of equity is what I've got as 18.66. What is the equity of what a lot? We calculated it. We got 33,920. So 33,920 plus what is the cost of debt? We go to the question to go and ask for it. The question told us their corporate debt is going to have a rate or cost of 0.5% above the treasury bill rate, which is 9%. So my cost of debt should be equal to 9 plus what? 0.5. It's above the 9% by 0.5. So I'll say this is 9.5%. Don't forget about tax. Tax rate is 35%. So this is 0.65. And the value of hot a lot debt, we said is 17,400. And this is 17,400. And then the total capital is 17,400 plus 17,400 plus 33,920, and this is 51,320, 51,320. And what is the WACC? So 18.66 times 33,920 equals plus bracket 9.5 times 0.65 times 17,400, and then all divided by 51,320, and that is giving you a WACC of 14.43%. Look, if you have to say about 14%. So this is what you need to use to discount the cash flows associated with the project in order to calculate the NPV of the freezer business to conclude as to whether the project is financially acceptable or not. So this is the case, and this is part of the NPV question. So you look at what you've done, and the examiner will be expecting to be on a fire. You have to be moving. It's not something that you are going to hesitate. You have to be on the fire. You have to be moving. Otherwise, you know the principle, but you never get there. Okay, so that is the project specific cost of capital, and that will call for you when the project we are going to do is in a new industry. We are in a new industry. We're going to do the project in the new industry. Project specific cost of capital is actually what calling you. B is saying corporate debt is often assumed to be risk free. Explain whether this is a realistic assumption and calculate how important this assumption is likely to be to hot a lot estimate of a discount rate in B above. For this purpose, assume that hot a lot and the 4 freezer companies all have a debt beta of 0.3. Can we say debt is assumed, as Miller and Modigliani said, that debt is assumed to be risk-free? We cannot say that. What debt is that? Corporate debt. Is company debt supposed to be risk-free? When we say a debt is risk-free, it means there is no even likelihood that you wouldn't get your money back. Don't forget, a company is a limited liability. And once a company is a limited liability, there are liabilities is restricted to the value of the company. Should the company liquidate now, we have to sell the asset to pay off the liabilities. So assuming the corporate debt is 100 million and we sell the company's asset, and then the company's asset brought in proceed of, let's say, 20 million, what should happen? The debt holders will go home less of 80,000. A company is a limited liability. That's the end of it. So you can't say corporate debt is risk-free. It's an assumption Miller and Modigliani made. Corporate debt, there is the risk of default in terms of interest and in terms of what? Principal. So you can't say corporate debt is risk-free. Even government debt cannot be assumed to be risk-free. We know what is happening in the world. Some countries are now struggling. Their governments are not in position to service their debt. So some government debt cannot be said to be what? Risk-free. But in theory, we assume government securities are risk-free because it is more likely that the government will pay. I mean, where is the government of the country running to? Okay, that is why we say that. So corporate debt is not risk-free. And the question is telling us that if the corporate debt is not risk-free, as you are saying, and the beta that will measure the risk of the debt is equals to 0.3, then what would have been the project specific cost of capital? If you remember, the full formula for the asset beta is this. If you remember here, the full formula for the asset beta is this. But we have been assuming debt beta is risk-free, and as such debt beta is equals to 0. So all the analysis that we did, we forgot about this bit of the formula. Now that they have given us a debt beta of 0.3, we can't forget about it. We have to do the whole thing. So we're going to go through the same process, but now we're not doing only this bit. We are also doing to include the other side of the formula. So I'm going to pick it from your note because we know how to do that already. So when we come to the B, we're going to say that when we got the geared beta average, it was equals to 1.175. Because it was geared, we have to ungear. So we said we need to calculate the asset beta. Now we have to bring the whole formula. So this is what we did initially. Okay, the 1.175 times the equity value, debt value multiplied by the net of tax, plus, because debt beta is not equals to 0, we have to continue. Bring the debt beta, multiply by debt beta net of tax, equity multiplied by debt net of tax, and that will give you your ungeared. When you get the ungeared and you are also going to re-gear, it's the same thing. Put it in that formula. The re-geared, this figure is 1.07. This is the gear that you are looking for. Now what a lot equity is this? We only did this bit, isn't it? But now debt beta is not 0. So we have to open the whole bracket and you solve it mathematically. You will get the equity beta geared of that. And then you put it in the capping and then you put it in the WACC. So what what this note is trying to explain here for you is that when you go there and they give you the debt beta, you cannot discard this bit. You would have to what? Obviously include it. Okay, so that is basically that. So now let's move on to the next. Okay, there's third bit of WACC. So when the examiner asks you to calculate WACC, you have to be very careful. What WACC? Is it my normal WACC as we did last week? Or is it a project specific WACC? If it is my normal WACC, how would the question be? I am in the education industry and I'm going to do a project again in the education industry. The cost of capital I need is my current WACC, which is the normal way. So this is what we will do. But I am in the education industry. I'm diversifying to go and do a project in the mining like freezer industry. My business risk is changing. I would have to what? Calculate the specific WACC for this particular project. Okay, the third WACC the examiner might ask you to calculate is what we are referring to as the WACC of combined activities. Okay, and what will be the combined activities? This is the case. Let me also explain the scenario in case the examiner does it. I am in the education industry. I am also doing something in the mining industry. Okay, if I want to appraise investment in education alone, I will need project specific WACC. If I need to do project in the mining industry alone, I will need project specific WACC reflecting business and financial risk for each of them respectively. That is it. However, if I am doing education and I'm doing mining as a company, what will be my company's overall? Let's say my company is called Company A. And my company A is doing education activity and doing mining activity. I don't need WACC specific for education. I don't need WACC specific for mining, but I need WACC for the whole company A. And this whole company A WACC will be the WACC of combined activity because company A is doing more than one activity in more than one industry. And every WACC should comprise of the business and then financial risk. So if I want to calculate the WACC of A as a whole, what am I supposed to do? This is the argument. So when they ask you to calculate work, don't run into it that you're going to calculate anything. It doesn't work like that. You ask yourself, what work? Is it project specific work? Is it my current work? Is it my work of combined activities? This is how you need to lead yourself. The work of combined activity will come when I have to calculate the work of a company that is doing more than one activity in different industries. Okay, and the work should reflect business and financial risk, whatever work it is. Okay, so to calculate the work of B, company A, what will happen? Because company A is in the education industry, company A will face a business risk here. So I need to get the asset beta of in the education industry. I also have to get the asset beta of the education industry as well, isn't it? So this is how it should be moving. This is how it should be moving. So we're going to say that if I get the asset beta here, it is measuring the business risk in the education. It's also measuring the business risk of the mining. Company A as a whole will be facing, okay? Company A as a whole will be facing both business risk in the education and business risk in the mining, isn't it? So my total business risk of the company is the combination of these two, and that is what is called the combined asset beta, and is calculated as the weighted average of these two asset betas, okay, using their corresponding values of each of them in the whole company, which I'm going to use figures to illustrate. So it follows the same process as the project specific work, but now we're going to have two asset betas, and to bring them together you weight them by calculating their weighted average beta, by calculating asset weighted average beta. So let's go to our note and I'll give you the stages. So first one is identify proxy beta for each activity, ideally from each respective industry, and gear each beta to determine the asset beta of each activity, measuring their business risk. Get the market value of each of the activities and weight them to calculate the weighted average, which is called the combined asset beta. And if you get the combined asset beta, you're going to ask yourself, is my company having debt? If the overall company is having debt, then I am going to say I have to re-gear to bring my financial risk, put it in the capping, and then you work it and you get the work of the whole company. Let's take this example to illustrate. Bigande PLC. Okay, Bigande PLC. Bigande PLC provides training and financial services. The training service accounts for 2/3 of the value of the company. I need to change something here. Put a full stop here. There's a typing error here. The training service accounts for 2/3 of the value of the company. Then I will say the company has a debt to total market value ratio of 30%. Okay, the average beta and debt to total market value for the financial service sector are 0.9 and 25%. The average beta and debt to total market value for the training service sector are 1.5 and 12%. Other information: the equity risk premium is 3.5%. and the rate of return on short-dated government stock is 4.5%. Bigande PLC can borrow at 2.5% above the risk-free rate. Tax on corporate profit is 40%. Assume that debt is risk-free. Estimate the cost of equity capital and the weighted average cost of capital for Bigande PLC. What cost of equity am I supposed to think of? Okay, when I read this question, I see this is a company providing training and at the same time financial services. So if I need the work of the whole company and they are doing two activities, examiner is calling me work of combined activity. And what will I do? I need to first look for a proxy company. Proxy beta. So I go straight here and I will say my proxy beta. I need to get proxy beta from each of the industries in which the activities are being undertaken. I have the training, I have the financial services. When I go there, what is the training beta? The beta given is straightforward. The average beta and debt to total market value for training service sector are 1.5. So training is 1.5, and then for the financial service is 0.9. These betas, are you geared or are you ungeared? Don't forget about that. Are you geared or are you ungeared? When we go to the question, all the sectors are having what? Debt. So if they are having debt, then their betas are geared. So if they are geared, then it calls for me to what? And gear to get the asset beta. I'm assuming debt is risk free because they haven't given me any debt beta. So the other side of the formula, I am not interested. So I will say the asset beta should be given as the equity beta, equity over equity plus what? Debt. 1 minus t. So I have to get the asset beta for the training. I also have to get the asset beta for the financial services. And I'm going to fill that formula. The asset beta will be equals to its equity beta of 1.5 multiplied by its equity. When we go to that sector, the training sector, they said debt to total market value. Debt is 12%, so equity should be 88%. So I will say 88 divided by 88 plus the 12%. What is the tax rate? Tax rate is given as 40%, so I will say 60%. When I solve this mathematically, it's giving me 1.387. I do the same thing for the financial service. Its beta is 0.9 geared. Multiplied by financial service sector. What is your debt? Debt represents 25%. So if it's representing 25%, then I will say equity will represent 75. 75 plus 25. Tax is 40%. Net is 60. So this is 0.75. So this is measuring the business risk in the training. This is measuring the business risk in what? The financial service sector. My company as Bigande PLC will face business risk in the education or training and business risk in the financial service sector. What will be my overall business risk? It's not simply this plus that. No, it's the weighted average because the value of the company, this is not 100%. This is not 100%. So I need to calculate what is called my combined asset beta. This is the only difference between combined work and then project specific work. Combined asset beta, and that combined asset beta, which is represented as BAC, is the weighted average of these two using the market value of your training and your financial service in the whole company. So I'll say training and financial services. Training beta is 1.387 multiplied by plus the financial service, it beta is 0.75 multiplied by, I don't know their values. I have to go to the question and go and look for their values. When you come here, the question said up here, the training service account for 2/3 of the value of the company. So if I'm doing financing and then training, and training accounts for 2/3, then it means the financing should account for 1/3. So the value of training in the company is 2 out of the 3, and the value of the financing is 1 out of the 3. And I will calculate the combined asset beta, and that combined asset beta is given 1.175. Okay, 1.175. It means this is the business risk of the whole company. This is the business risk of the whole company. So if my company is facing this business risk, my next question is, have I got debt? If my company has got debt, then I wouldn't face this business risk only. I will also face financial risk, which will call for the re-gearing to bring the financial risk, isn't it? So I go and ask the question, do we have debt? That is why I changed this. Because when you read it's like the training service sector account for 2/3 of the value of the company and has a debt to total market value ratio of the 30%. What they want to say is that it's the company that is having the debt equity, because they gave us the financing and training services in here. Okay, so the true question is, the company has a debt to total market value ratio of 30%. So if my company is having debt of 30%, then I will face financial risk. I have to re-gear. So let's go straight and we go and re-gear. So I will say re-gear, the same formula. The asset beta is equals to the equity beta geared, equity plus debt, 1 minus T. So I have got the asset beta to be 1.175 is equals to the equity beta geared. What is the equity of my company? If my whole company debt is 30%, my equity should represent what? 70%. Tax rate is 40%. Net of it should be equals to the 60%. I pick my calculator. 30 times 0.6 plus 70 times 1.175 divided by 70, and I will get 1.48. So when I get this 1.48 as the re-geared, I put it in the capping. What is my cost of equity to my company? Risk-free plus the equity beta, market return minus the risk-free. I go to the question, where is the risk-free rate? I've gone to my principal. Now I come to the question for answers. So where is the risk-free rate? Question says the equity risk premium is 3.5 and the rate of return on short-dated government stock, we assume government securities to be risk-free, is 4.5. So my risk-free is 4.5. Equity risk premium is 3.5. So I will say risk-free here is 4.5% plus my beta of 1.48. Equity risk premium, don't forget, is the difference between these two, which the examiner has done it for me at 3.5. What then should be my cost of equity? 1.48 times 3.5 plus 4.5, and that will give me cost of equity of 9.68. Therefore, if it's 9.68, what will be my company's overall WACC? And this WACC is the WACC of combined activity. Okay, and we said WACC is cost of equity, equity over equity plus debt, plus cost of debt, 1 minus T, debt divided by equity plus debt. Okay, my cost of equity we said is 9.68%. What is the equity? Equity here we said is 70%. 70% is 0.7 plus what is the cost of debt? Let's go and ask the question. My cost of debt, according to the question, is saying Bigande PLC can borrow at 2.5% above the risk-free rate. Risk-free rate is 4.5. So 2.5% above should be equals to, is it 4.5 plus 2.5, which is giving me 7. Tax rate is 40%, so here should be 0.6. And debt represent what? Is it 30%? And what is the WACC? And that WACC is what is simply giving us 8.04%. And this is the WACC of the combined what? Activities. So WACC is a trouble, to be honest. So when they tell you to calculate WACC, you need to ask yourself by leading yourself, do I need my current WACC? Do I need a project specific WACC? Or do I need WACC of what? Combined activities. I wish you well on that, because definitely whether you like it or not, a WACC question is coming either as a part of a question which might be hiding, or the examiner can tell you to calculate it before he will tell you to calculate something else with it, or he will just simply keep quiet and you have to what? See that straightforward. You need to calculate the WACC before you can go to the next stage. Okay, so that is basically that chapter. and I'm going to tell you to read assumptions and cap him. Nobody even asked a question on that. So I'm picking you straight to adjusted present value, chapter number 7. The moment we do chapter number 7, the hard work is over. What is coming is a rollover of whatever we've done before. So make sure you revise before I will see you next week for international investment appraisals and mergers and acquisitions. All of them are going to be the rollover from chapter number 2 up to chapter number 7. What is adjusted present value? If you remember when we did chapter number 2, investment appraisals, we said there are so many methods we can use to appraise investment. And those are divided broadly into discounting and non-discounting. Non-discounting, we are not interested. So we learned MPV, internal rate of return, discounted payback, internal rate of return, modified internal rate of return. We saw profitability index. We saw duration. The only bit that we didn't see is adjusted present value. So adjusted present value is another form of appraising investment. It's another technique that we can use to appraise investment, and this is what APV is saying. Okay, if you remember what we have just done, when we are calculating MPV, what are we going to say? We are going to say that I have got my net cash flow. I have to discount using the WACC. And then when I sum them together, it gives me MPV. And we all have agreed that according to MPV approach, this WACC should be the appropriate WACC. For instance, it should be the project specific WACC that will measure the business risk and the financial risk associated with the project, which is saying that, okay, the cash flows are discounted using appropriate cost of capital consistent with the risk that goes with the cash flows. The argument here is it truly that what we've done in MPV is correct? Miller and Modigliani said MPV. Unfortunately, you are wrong. Okay, so those Miller and Modiglianis, they are making life very comfortable. I normally say that, comfortable, so far as P4 is concerned. Okay, so they are claiming that, okay, NPV idea of discounting the cash flows with the cost of capital that is consistent with the business and financial risk associated with the project is a brilliant idea. However, the application of that idea is not truly consistent because business risk is coming as a result of your operations in the industry. Financial risk is as a result of the way you financed the project, which is debt equity. So when I come to this net cash flow, something like sales, variable cost, specific fixed cost, tax savings on capital allowance, whatever the cash flows that we use there, has it got something to do with the way you financed it? Whether I finance it through equity, I finance it through debt, the operation will happen. I will get my sales. I will incur the variable cost. So Miller and Modigliani is telling you that no. We cannot discount these cash flows using a WACC that should include financial risk, because financial risk is coming as a result of the way the project is financed. Okay, and the way the project is financed is irrespective to the way the cash flows will be got, because sales has got nothing to do with debt equity. It's got something to do with operations. An alternative name for business risk is operating risk. So Miller and Modigliani is telling us, now if we truly want to be consistent by comparing like against like, as the MPV was actually advocating, then we need to separate the cash flows into those cash flows coming from financing and those cash flows coming from operations, so that those cash flows coming from operations will be discounted using a cost of capital that is consistent with only business risk. And cash flows coming from financing has got nothing to do with business risk. It's got something to do with the financing. Therefore, we don't have to use a cost of capital to discount cash flows from financing activities based on a WACC that includes business risk to compare like against like. So all what APV is saying is that we have to divide the cash flows into the cash flows, net cash flows from operations, and discount them using cost of capital that is associated with only operations, and then get net cash flows with respect to what? Financing, and discount them using cost of capital associated with financing. And as such, you are comparing like against like. But we cannot sum up these two as we did in MPV and discount it by these two, because if I bring financial risk here, this is having nothing to do with financial risk. So APV is said to be the divide and conquer. We divide the cash flows into financing and operations, and we resolve the problem with MPV. So this is how the argument went. We criticize internal rate of return. We brought modified internal rate of return. We criticize discounted payback. We brought duration. Now, the almighty MPV is also criticized, and that has brought the adjusted present values. When you go to the exam room and the examiner wants you to calculate APV, it's hooray, it's straightforward. I'm going to make it very simple for you, because as I keep telling you, it's the approach students use to answer questions. If you look at me, I always come to the question with authority, because I have got the principle behind me. So I come to the question. If you want me to do this, principle says this is how it should be done. So if this is how it should be done, then give me this, give me that, where is it? Give me this, where is it? If they don't give it to me directly, then the examiner is hiding it. And as such, I tell myself I have to go and be working around it to bring myself to the level. That is how the whole thing is supposed to be answered. So let's start. When they tell you to calculate APV, APV is simply calculated as your base case MPV plus or minus the PV of finance effect cash flows. And my base case MPV is my net cash flows, which is sales, variable cost, specific fixed cost, tax savings on capital allowance, initial investment, residual value, working capital. As we were doing the MPV, I come and get the net cash flows. These net cash flows are coming from operations. So what discount factor should I use? The discount factor I have to use should be consistent with only business risk, only operating risk. And that discount factor is the discount factor that will measure only business risk. If you remember, if we have only business risk, it means we are having a company which is all equity finance, if you remember. So the cost of capital you need here is the cost of equity and geared. Because cost of equity and geared will measure only the business risk. And what is the way to calculate it? If you go to this, your note, page chapter 7, this is not taught, because the assumption here is that you know how to generate relevant cash flows from chapter number 2. How to calculate cost of equity and geared. We know it from chapter number 5 and chapter number 6. Okay, when we did chapter number 5, we did Miller and Modigliani's. So if the question had given me APV question and I need to calculate the cost of equity and geared, anytime geared and ungeared thing is coming in, there's one group calling me, and that group is Miller and Modigliani. Let me simplify it for you here, because to me, this is the bit that is challenging for students. Okay, so the cost of equity and geared I can think of Miller and Modigliani preposition 2. If you remember, we said the cost of equity geared is equals to cost of equity ungeared plus cost of equity ungeared minus cost of debt, debt 1 minus T divided by equity. So when I am doing my APV and I read the question and the examiner had given me a cost of equity geared, in my answer, I don't need cost of equity geared as the discount factor. I need cost of equity ungeared. So giving me the cost of equity geared, I have to convert it from geared to what? Ungeared. And Miller and Modigliani is calling me. Which Miller and Modigliani? Because cost of equity is given, I need cost of equity in terms of preposition 2. We also learn in preposition 3, which deals with WACC. And that is saying that your WACC geared is equals to your WACC ungeared into bracket 1 minus dt divided by E plus what? D. We've done all this before. So when I'm giving APV question and the examiner had given me a WACC and that WACC is geared, what do I need? I need cost of equity ungeared for the APV. And we all said when a company is ungeared, its cost of equity is equals to its WACC. So the WACC ungeared is the same as the cost of equity ungeared. Therefore, if you give me the WACC geared, I can use this formula, make the deduction to come and get the cost of equity ungeared, and I put it here, and when I put it here, I discount it to come and get my base case what? MPV. So this is the flow I will expect you to be leading yourself through in the APV calculation. I need my base case MPV. I will go straight and say, where is the relevant net cash flows? I get my relevant net cash flows. Where is the cost of equity ungeared? If the cost of equity ungeared is not given to me, but cost of equity geared is given to me, I call preposition 2, put it in the formula, convert it to ungeared, go and discount it. I've got the base case MPV. Before I will come and sort the financing out. If WACC geared is given, I call preposition 3, convert the WACC geared to ungeared, which is the same as the cost of equity. I come and use it to discount it. Then the examiner can use a third way in calculating the cost of equity ungeared. And that third way is he will give you a beta. He will give you a beta. So, given a beta, how will I calculate the cost of equity ungeared? If you remember, we said capping. The answer of the capping depends on the beta you are putting in. If I'm looking for equity geared cost of equity or geared cost of equity, I put in what? Geared beta. When I put in ungeared beta in the capping, it gives me ungeared cost. The beta is the input. So if I read the question and the examiner had given me a beta, I use that beta as the proxy. So pick the proxy beta. And when you finish, that proxy beta asks, are you geared or are you ungeared? If that proxy beta is geared, then it's my job to what? Ungear it. And when I ungear it, I will have the asset beta measuring only business risk. And my next level is, be with me here because I tend to get a lot of questions here. When you are doing APV, what cost of capital do we need here? We need the cost of equity what? Ungeared. So when I ungear and I get this asset beta, there is no need for me to re-gear it. We re-gear to bring financial risk. I don't need financial risk here because I've separated them into two. So APV, there is no need for you to re-gear it. Let me say it again. There is no need for you to do any re-gearing so far as APV is concerned. Pick the proxy beta and gear it and put it in the capping. And the moment you put it in the capping, it will give you the cost of equity ungeared. it will give you the cost of equity and geared. And then I have got this. So which one you will use? Unfortunately, I can't stand here and say it. Okay, that's why I'm doing these branches for you. I've told you already, when you see me teaching and I'm doing these branches, that is how I'm expecting you to be interacting with the question. I have to calculate APV. I need my base case MPV. What will be the relevant net cash flows? How do we get relevant net cash flows? Sales, variable cost, specific fixed cost, tax savings on capital allowance, initial investment, residual value, working capital. Straight, I've got the net cash flows. This box is ticked. I need the cost of equity and geared. Question, what have you given me? Have you given me cost of equity? Have you given me WACC? Or have you given me beta? Then the question will tell you, I've given you this, can't you see? So if he's giving me beta, then I switch the brain. Okay, the beta you gave to me, I'm picking as a proxy beta. That beta you've given to me, are you geared or are you ungeared? Question will tell you, the company I gave it beta is having debt. Can't you see? So if it's having debt, then that beta is geared. Okay, if it is geared, then I have to ungear it. The moment I ungear it, I've got the asset beta. Asset beta measures only business risk. I need a cost of capital that measures only business risk. So there's no need for me to re-gear. Put it in the capping. I get the cost of equity ungeared. I come and discount it with it. I've got my base case MPV. Then I'll go to the finance effect. Your syllabus is very straightforward. Your finance effect items you need to know are issue costs. As a result of me going to raise the money, I might incur issue costs. Isn't it? Therefore, that is not coming because of operations. That is coming because of financing. What will be the present value of the issue cost? When we finance it by way of debt, we have to pay interest. And tax savings on interest is going to be there for us. So what will be the PV of tax saved on interest? These are the things you're going to ask the question, and you see the question giving them to you. The last one is you have to think about what is called subsidy. And subsidy, some people call it cheap loans. Some people call it cheap loans. As a result of doing the project, maybe the government will be interested, and the government will say that, oh, instead of you raising loan at £100 or let's say 10%, I'm going to give it to you at let's say 6%. You save what? 4%. So that is basically the APV. When they ask you to calculate APV, that is it. Okay, that is it. Okay, so let me take you to your note. We pick this one to illustrate. Okay, I am going to pick a past question to summarize everything. As you have the recorded, you can just look at the small bit. I'm going to pick a past question to teach all of them together, because the small bit was done towards the past question. So when I do it, that will explain all that. Okay, under what situations APV is better than MPV? This question, the examiner can ask you directly as it is, or the examiner can hide it. Sometimes, some of the questions, the examiner is not going to tell you, use APV or use MPV. He will create the question and straightforward evaluate on financial grounds as to whether the project is financially acceptable or not. When you face such questions, then the examiner don't tell you specifically what you should use. Then what you need to act or tell yourself is this: I can either use the MPV or I can use the APV. I can only use the APV if these conditions are prevailing. Is financial risk changing significantly? And when financial risk is changing significantly, it means our debt equity is changing, and the debt equity is what is measured in the capital structure. Is business risk changing significantly? Business risk is the same as operating risk. Okay, I normally tell students these 2 points, you cannot necessarily use it to distinguish APV or MPV from a given question. But even though we are saying that as long as business risk is changing significantly, financial risk is changing significantly, we have to divide them into cash flows associated with operations and cash flows associated with financing. But that is also applicable in terms of project specific work anyway. So when it is a given question and he doesn't specify what approach, this is not the case. But when he asks you to write, then you have to mention them. What will help you to know that the examiner wants APV is that the examiner is going to state in the question that there are subsidized loans or there are cheap loans. The moment there are cheap loans or subsidized loans, APV is better than MPV. The moment there are issue costs, APV is better than MPV. The moment there are complex tax situations, one company paying some percentage, another company paying some percentage, big companies paying this percentage, small companies paying this percentage, different tax percentages. This is where we say APV is what appropriate, because there is tax or complex tax situations. So the idea is, have I seen subsidized loan? Have I seen issue costs? APV is calling me, even if the examiner hasn't told me. Even if the examiner hasn't told me. So listen to these small things that we did here. You can just listen to the videos there, or you can go through them. I'm going to sum all of them up in a big question so that we see how the APV is fully calculated. What are the practical problems of APV? Okay, when I finish doing this, I will come back to that, because by then you will be able to appreciate it better. So let's take this past question to summarize whatever the APV is about. So let's go. The managers of Straya Incorporation are investigating a potential 25 million investment. The investment will be a diversification away from existing mainstream activity and into the printing industry. Something is clicking, because they're saying the investment is a diversification. Business risk is flashing me. So whilst I'm reading, at the back of my mind, it could be APV or project specific work. It can only be APV when I see issue costs, when I see subsidized loans. So this is what my principal has told me. So whilst I'm reading the question, I'm heading myself towards the answer. Okay, 6 million of the investment will be financed by internal funds, 10 million by a right issue, and 9 million by long-term loans. The investment is expected to generate pre-tax net cash flows of approximately 5 million per year for a period of 10 years. The residual value at the end of year 10 is forecast to be 5 million after tax. As the investment is in an area that the government wishes to develop, a subsidized loan of 4 million out of the total 9 million is available. This will cost 2% below the company's normal cost of long-term debt finance, which is 8%. Straya's equity beta is 0.85 and its financial gearing is 60% equity, 40% debt by market value. The average equity beta in the printing industry is 1.2 and the average gearing 50% equity, 50% debt by market value. The risk-free rate is 5.5 per annum and the market return 12% per annum. Issue costs are estimated to be 1% for debt financing, excluding the subsidized loan, and 4% for equity financing. These costs are not tax allowable. The corporate tax rate is 30%. Estimate the adjusted present value. I don't need this to tell me that I need to use this on the basis of APV. A question has shown me subsidized loan issue cost, and then I'm also moving to somewhere else. APV is flashing me. So some of the questions, as I told you, the examiner A would have told you evaluate and assess as to whether the project should be accepted on financial ground. Because I've seen subsidized loans, I've seen issue costs, APV is calling me. Okay, APV is calling me. B is comment upon the circumstances under which APV might be better method of evaluating a capital investment than net present value. This 5 marks, even though what I'm going to say is what I'm going to be highlighting more when I do the revision. If I'm sitting down in this exam room and this question is in front of me for 20 marks, where will I start? Most of you start with A because I know how to calculate APV. You get into the APV, you don't come out. And time is over. So when you go to the exam room, my B here does not depend on the A. And do I know the circumstances? Oh, business risk is changing significantly. Oh, financial risk is changing significantly. There are complex tax situations. There is issue cost. There is subsidized or cheap loans. These are the reasons why APV will be better than the MPV. How many minutes will you take to answer to get this 5 marks? Look at this question. It's a 20 marker question. My break-even point for every question is to get half. If every question I'm able to get half, obviously I will get a minimum of 50 to pass the exams. So my target in the exam room is every question I need half of it. And this 20 marker question I need 10. So if I can quickly write the 5 to get the 5 marks there, whatever I need out of the 15 minimum is 5. If I'm able to do something and I'm not even able to get the whole 15 and I get even 8 out of that 15, I have passed this question. For me, Fred, I am very, very comfortable and happy in the exam room. Okay, most of you tend to be doing so many the hard ones because you want to calculate. And by the time that you finish the hard one, time is gone, you are under pressure, and what happens? You cannot even, by the time you come to the B, you know the answer. You are under pressure. You don't write it to explain it well. You give short answers. Something you have to get 1 mark because you are in a hurry and you shorten it. You get half and then you don't pass it. Not that you don't know. I keep telling students day in and day out, ACCA is not testing only knowledge. It's testing how you can prioritize. What is the knowledge? How will you be able to manage yourself under pressure? It's all part of the exams. Okay, so it is tactical. It's not only having the knowledge. It is tactical. How you will be able to pick some questions, answer them, and you will be able to get the minimum of the 50. That is all the business. Okay, so if you go there, don't prove you know. Pass first. If you are able to pass and there is time for you, continue and show to the examiner that you are brilliant. I'll be so happy that I taught you. Okay, so that is the argument. Right, let's calculate the APV. If I have to calculate APV, this is where my eye is going to be. I need my net cash flows. I need my cost of equity and geared. So I will start this project. What will be the net cash flow? I need the base case MPV. I need the relevant cash flow. So I need to get years. How many years is this project supposed to go? Year 0. If I read the question told me I'm going to get pre-tax net cash flows of approximately 5 million per year for a period of 10 years. So the examiner had made it an annuity for me. Every year I'm getting the same thing. So I am going to say year 0, my initial investment is going to be the 25 million. Year 1 to year 10, my net cash flow after tax, they said 5 million before tax. What is the tax rate? Tax rate is given as 30%. So I will say multiply by 0.7. Year 1 to 10, I will get net cash flows of 3.5. I asked, is there a residual value? Question said the residual value at the end of the 10th year is forecast to be 5 million. So I will say year 10, my residual value is equals to what? Is it 5 million? These are the cash flows. Okay, these are the cash flows. If these are the cash flows, this is supposed to be discounted using what cost of capital? Because it's APV, I need the cost of equity and geared. and what will be the cost of equity ungeared. This is where my eye is. I'm not writing this to the examiner, but I picture it. It's on my eye. This is where my eye is. I've got the net cash flows. I need the cost of equity ungeared. How will I get ungeared? Miller and Modigliani is calling me. Is it preposition 2? Is it WAC, preposition 3, or is it beta? I go to the question. Question, have you given me cost of equity? Have you given me beta? Or have you given me WAC? When I come to the question, I see betas here. Which beta do I need? The question is telling me I am diversifying away from existing mainstream activity into the printing world industry. So where should I pick the proxy beta? The proxy beta should come from the industry in which the new project is supposed to be undertaken. Look at what the examiner did here. Strayer's equity beta is 0.85 and its financial gearing is 60% equity and 40% debt. Do I care? I don't care, because I am diversifying. So I'm not interested in it beta. I am diversifying into the printing industry. So the beta should come from the printing industry. So we say the average equity beta in the printing industry is 1.2. So I will say my proxy, I leave space there. I say to calculate the cost of equity ungeared, I need my proxy beta. What is the proxy beta? It's 1.2. I need to ask a question. This proxy beta, are you geared or ungeared? If I come here, question said equity beta. Once it's equity beta, it could be geared or ungeared, dependent on where I'm picking from. Where am I picking it from? I'm picking it from the printing industry. Okay, printing industry. Have you got that? Question says the average gearing is 50% equity, 50% debt. So that printing industry is having debt. So once it's having debt, its equity beta of the 1.2 is geared. I'm talking and I'm interacting with the question. I won't skip it. So my principles is what I'm using to ask the question. What is it? What is it? What is it? What is it? You won't skip it. Okay, so this is geared. If this is geared, then my second stage is I have to ungear. How will I ungear? Miller and Modigliani said the asset beta is the equity beta geared. Equity over equity plus debt, 1 minus the T, isn't it? Now I need to do the filling. This is BA is equals to the 1.2. That industry, what is your equity? They said 50. 50 plus debt 2 is 50. Tax rate is 30%, 70% here. And what is the beta measuring? Only business risk. The beta measuring only the business risk. Okay. Beta measuring the business risk here. If you solve this mathematically, is 0.71. So if I've got this beta, where is my I? My I is here because they've given me beta in the question. So I say, if I've got the asset beta and I want the ungeared beta, put it in the capping. So I will say my next is the capping, which will give me the cost of equity ungeared, risk-free plus the asset beta into bracket market return minus risk-free. I go to the question, where is risk-free? Where is market return? When I come to the question, where is risk-free? Question says, Fred, I've given you risk-free here of 5.5. I've given you market return here of 12%. I ask what I want from the question based on the principle. Life will be very, very comfortable. But when you look on the surface of the question like this, the examiner will be taking you away from the principle and you'll be making your mistake. So let the question be there. Look at the requirement. What am I supposed to do? Go to the principle. Come and ask the question. I need this. Where is it? I need that. Question will supply you with all those answers. And life will be very, very comfortable. So I will say risk-free rate is 5.5%. The beta is 0.71. Market return is given to us as what? Is it 12% minus 5.5%? And that cost of equity is given us approximately 10%. So this is the ungeared cost of equity. If it is ungeared cost of equity, I come here, come and put the 10% up. I go to the table, 10% year 0 obviously is what? 1. 10% annuity 10 years is what is given 6.145. 10% present value, 10 years, is given 0.386. Multiply 25 minus, this is given 21.508, and the last one is 1.93. When you sum, this is what is called the base case MPV, and that is simply 1.562 minus 1.562 minus. I've done my base case MPV. APV is the base case MPV. These two done. Then I will come and do plus or minus PV or finance effect. What are the finance effect? I have to sort out issue costs. I have to sort out tax saved on interest, and I have to sort out subsidies. When I finish, add them together. APV. Here you are. Okay, so let's go and sort out the issue costs. Let's sort out the issue costs. What will be the issue cost? Question. I need issue cost. What is the question supposed to tell me? Whilst I was reading, this is the paragraph. I see the issue cost. This is the paragraph. I can see the issue cost. It said issue cost are estimated to be 1% of debt financing excluding the subsidized loan and 4% for equity financing. Okay, according to the question, we have to make what? 25 million investment. Up here, question is telling me 6 million of the investment will be financed by internal funds, 10 million by right issue, and 9 million by what? Long-term loans. So that is the debt, 9 million. But when you come down here, he said, as the investment is in an area that the government wishes to develop, a subsidized loan of 4 million out of the total 9 million is available. So out of the 9 million, 4 million is subsidized. 5 million, of course, is not subsidized. And the question is telling us the issue cost is 1% of debt finance, excluding the subsidized loan. So if the total loan is 9 million and subsidized is 4 million, 5 million will be what? Unsubsidized. And the issue cost on it is going to be 1%. So I'll say issue cost on the debt is going to be the 9 million minus the 4 million, which is 5 million, multiplied by 1. And that is given 0.05. I also have to look at the issue cost on the equity. And what is the question saying? Question saying, and 4% for equity financing. Out of this 25, 6 million is coming from internal funds like reserve, and then 10 million is coming from right issue. Both are equity. So total equity is 16 million. But remember, retained funds or internal funds is there. You are not going to issue it, so you don't incur any issue cost. It's the right issue that you have to issue, and as such is 10 million multiplied by the 4%. So I will say this is going to be 10 multiplied by what? 4%, and that is 0.40. When I sum, my total issue cost is 0.45, and issue cost is happening in year 0 because you have to incur it upfront. So if it's happening in year 0, what should happen? Present value of any cash flow in year 0 is the same thing. So issue cost for 1 mark is automatic. You need to pick it. Okay, so I will say the PV of the issue cost, because it's happening in year 0, is the same as 0.45. That is done. I have to go and sort interest and then what? Subsidy. That's it. So let's go and look at tax saved on interest. Tax saved on interest. Okay, the interest we have to pay, it should be on the loan. The total loan is 9 million. Question said 5 million is a normal loan. And then 4 million is what? A subsidized loan. Okay, so what is the meaning? I need to pay interest here, and I need to pay interest. What interest rate will I pay? Let's go here. According to the question says the 4 million out of the total 9 million will be the subsidized loan. This will cost 2% below the company's normal cost of long-term debt finance, which is 8%. So the one I haven't gone as a subsidized loan, I will pay 8%. But the subsidized loan, I will pay what? only less by 2%. So it's going to be what? 6%. So on the subsidized loan, it's working. Mine is working. So it's perfect. Okay. So on the subsidized loan, I am going to pay 6%. And on the normal loan, I will pay 8%. So what will be the interest? 8% of the 5 will give me 0.4, and then 6% of 4 will give me 0.24. So my total interest will be equals 0.4 plus 0.24, and that is going to be, is it 0.64? So if it is 0.64, this is the total interest. And whilst I pay this interest, I will save tax. So what is the tax saved? And anytime you want to save a tax on expense, you pick that expense and you multiply by tax rate. The tax rate given in the question is 30%. So the tax saved will be 30% of the 0.64, which is 0.192. So every year from year 1 up to year 10 of the project, I will save tax because of interest of 0.192. My value, we need the present value of the tax savings. So what is the PV? The PV here will be year 1 to year 10. I have got a tax savings cash flow of 0.192. I need the discount factor before I will get the PV. Now be with me here. APV told us that the cash flows associated with the operations, as we did here, these are the cash flows associated with the operations. We have to discount it using cost of capital associated with operations. And the cash flows associated with financing should be discounted using the discount factor associated with the risk that goes with the financing. However, how will you be able to calculate the cost of capital associated with the tax savings on interest? APV couldn't tell us, unfortunately. So be with me here. This is also a point of contention. APV couldn't tell us the discount factor we have to use to discount the cash flows associated with all the financing cash flows. So the assumption is Miller and Modigliani assumed either the risk-free rate or cost of debt. Whichever you assume, the examiner will mark you right. Is the major problem of APV. So when you are discounting getting the present value of the finance effect cash flows, APV couldn't suggest any cost of capital because it can't be calculated. And therefore, they assume either the risk-free rate or cost of debt. So we are going to assume risk-free rate of 5.5%. If I assume risk-free rate, you assume the cost of debt. All of us are right. So when you are solving APV questions, you will see some of the questions, the finance effect, they said risk-free rate. The same question, they are also saying what? Cost of debt. In another solution, is the same. All of them, the answers will be different, but you are all correct because of the problem of APV. So finance effect cash flows discounted using either risk-free rate or cost of debt. So here we are assuming risk-free rate and it's 5.5. I need annuity factor of the risk-free rate of 5.5 for 10 years. When you go to the table, you don't see 5.5. How will you do it? 5.5 lies between 6% and what? 5%. So I will pick 5% 10 years annuity, and I will also pick 6% 10 years annuity. Add the two together, divide by 2, and that will give me the figures. So 5% 10 years 7.722 plus 6% 10 years 7.360 divide by 2 bring me to the midpoint. So 0.192 multiplied by 7.541, and what will be the PV? Times 7.541, and that will give you 1.448. as the PV. This is how you get the tax savings on the interest. Get the interest, multiply by the tax rate, and discount it using either risk-free rate or cost of debt. Now let's move on to the last one, which is the subsidy. And that's it. This is all about APV. So when APV come, I prefer it than MPV, because MPV is now that you have to struggle, go and calculate the project specific cost of capital and all that difficult. Subsidy. When we went in for the subsidized loan, then we are saving, is it 2%? Because instead of we paying the 8%, we paid 6%. So we are going to save 2%. But when we save 2%, remember, if you pay less interest, your taxable profit will be more and you have to pay more tax. So you don't save the whole 2%. You have to save net of tax. So tax rate, you have to multiply this 1 minus the tax rate. And tax rate is 30%, so I'll get 70% of it. So 2% times 0.7 is giving me 1.4%. Multiplied by what is the amount of the subsidized loan. It's not the whole 9 million, only 4 million is what we went for as the subsidized loan, and this will give me the interest. So 1.4 divided by 100 times the 4 million, and that is giving 0.056. So every year for the next 10 years I will get this money saved. If I get this money saved, what will be the PV of it? PV of it is year 1 to year 10. We said is 0.056. And this is the cash flow. What is the discount factor? This is also a finance effect. APV couldn't tell us. You can use risk-free or cost of debt. Okay, but be consistent. If you decide to use risk-free, cut across. If you decide to use cost of debt, use them throughout. So here we use risk-free here, and we said the 10-year 5.5 is 7.541. So I multiply here by 7.541. And what is the PV? So that times 7.541, and that will give me 0.422. 0.422. When I finish, this is where my focal point is. I've sorted them out one. I've got the base case MPV. I've got issue cost. I've got tax saved on interest. I've got subsidy. Bring all of them together. Your APV come out. So I will say my APV will be the base case MPV. And we've got minus 1.56 what 2. And then issue costs, we've got 0.45. It's a cost, so minus it. And PV of what? Tax saved on interest, which is simply, we calculated it and we've got 1.448. Okay, and the last one is PV of the subsidy, which we got 0.422. When you sum them up, this is what is called the APV, and is 0.142 minus. The interpretation is the same. If APV is equals to negative, reject it. If APV is equals to positive, accept it. Okay, so that is basically that. Our time is up, even past that. So get the time, read the problems. Problems of APV. We use Miller and Modigliani to calculate the cost of equity. Miller and Modigliani is full of assumptions. APV couldn't tell us the discount factor we have to use for the finance effect. So we use either risk-free or cost of debt. So have a look at them. And thank you very much for your time this evening. So next week, when I see you, is international investment appraisals and valuation of business. So thank you very much for your time, and I'll see you next week.